This is Canada, the country that's been invaded by the US twice. It's the world's second largest nation by landmass and ninth based on GDP output, nestled atop of the United States on the North American continent. It's a land cradled by three majestic oceans, the Atlantic, the Arctic, and the Pacific. The bond between Canada and the US is not just geographical. They share the world's largest international border, a staggering 8,891 kilometres, or 5,525 miles. Peel back the layers of Canada's geography and you'll discover a startling fact. A whopping 80% of its entire population resides within a mere 100 miles of the US border. Even more intriguing, in 2022, Canada marked a historic milestone. For the first time ever, its population surged by over 1 million in just 1 year, reaching a growth rate of 2.7%, a growth rate not seen since 1957. Yet, this rapid growth and population concentration are not without consequences. They're reshaping the Canadian economy in ways both promising and challenging. So, what are the fundamentals of Canada's economy? How has the housing market been affected? How are businesses affected? And finally, what's next for the Canadian economy? Historically, Canada's economic backbone has been its abundant natural resources. The nation's economic pulse has been significantly influenced by sectors like mining, lumber, oil, and natural gas. In 2021, these resources either directly or indirectly contributed to 17% of the nominal GDP, making up a substantial 51% of Canada's merchandise export value. Yet, there's a shift on the horizon. Canada's top exports, oil and vehicles, are witnessing a decline, a trend that might persist. Producing oil from Alberta's tar sands comes with a hefty price tag. Moreover, United States, Canada's primary oil consumer, is leaning more towards domestic production than imports. The automobile industry too hasn't regained its pre-2008 recession vigour. From churning out 3 million cars in 1999, production dwindled to 1.4 million by 2020. Since the financial downturn in 2008, Canadian house prices have soared, doubling in value. This surge is largely attributed to heightened consumer spending. In 2009, with the government's economic stimulus and the central bank's enticingly low interest rate between 0.25 and 1.75% for the next decade, Canadians were nudged towards accumulating debt for home purchases. The driving force? A blend of hope and concern that prices will continue their upward trajectory. However, the recent uptick in interest rates has momentarily tempered these soaring prices. Yet, for many Canadian renters, the aspiration of owning a home seems increasingly unattainable. A telling Ipsos poll stated that 6 in 10, 63% of Canadians who don't own a home continue to feel owning a home is completely out of reach or have given up on ever owning one. The Canada Mortgage and Housing Corporation, CMHC, identifies immigration as a pivotal factor bolstering rental demand. Many of Canada's newcomers opt for rentals over immediate home ownership, ensuring a steady demand for rental spaces. Immigration is in line with Canada's long-term plan. The nation plans to welcome an increasing number of immigrants in the next couple of years. This can put Canada's real estate market under even more stress, with real estate prices soaring even further. Interestingly, Canada's housing price trends aren't isolated. Other developed nations like the US and UK exhibit similar patterns, albeit at seemingly more reasonable rates. What sets Canada apart is its consumer behaviour. The borrowing and spending capacity of Canadians might be reaching its peak. Surprisingly, Canadians allocate a larger chunk of their investment capital to housing than to businesses. Here, business investment, encompassing non-residential structures, machinery, equipment, and intellectual property, totals a mere 9.3% of the GDP. In stark contrast, robust growth in housing investments has propelled Canada's net residential assets by 18.9%, accounting for 22.9% of the nation's wealth in 2021. In this Canadian narrative, many seem to prioritise housing investments over business ventures. And who could fault them? It seems a sound strategy until one ponders the source of future job opportunities in the absence of local business investments. Business investment is the lifeblood of economic growth. By bolstering the economy's productive capacity with a more extensive physical capital stock, it enables the production of more goods and services without necessarily increasing labour or resource input. Yet, when compared to the US, Canada's investment in business as a percentage of GDP seems somewhat lacking. Both domestic and international entities contribute to business investment. However, Canada's somewhat subdued domestic investment is often supplemented by foreign direct investment, predominantly from the US. It's a telling sign when Canadian enterprises seldom make global headlines. A survey involving 900 executives revealed a more risk-averse temperament among Canadians compared to their American counterparts. The current economic landscape showcases a disparity. 6 of the top 10 companies on Fortune's global revenue list are either American or Chinese. In contrast, Canada's frontrunner, Brookfield Asset Management, only clinches the 158th spot. Canada's economic idiosyncrasies are, in many ways, shaped by its proximity and relationship with the US. This close-knit economic bond has led Canada to mold its economic strategies in tandem with American influences. While American companies often set up shop in Canada to sidestep tariffs, their core operations and intellectual assets predominantly remain stateside. Moreover, many budding Canadian startups find themselves being snapped up by foreign entities, especially from the US. This trend is partly attributed to the fact that when these Canadian startups go public, they forfeit certain tax advantages, making them ripe targets for acquisition by larger international corporations. This dynamic has rendered the Canadian economy somewhat less innovative and productive than its southern neighbour. Even though both nations have about the same average salary, the American worker generates $75 per hour, while the Canadian counterpart produces $57. So, what's the secret sauce for Americans? It's not necessarily about working harder, but smarter. The crux of this productivity gap lies in capital intensity, the investment in machinery, tools, innovation, and capital per worker. Canadian businesses invested about $13,000 per worker on capital, while their US counterparts spent $20,500. Additionally, Canada's R&D expenditure is relatively modest among the G7 nations. Ultimately, productivity growth is intrinsically tied to enhanced living standards and per capita income. Despite facing economic challenges, Canada's resilience and strengths are evident. With its stable democratic governance, amiable citizens, a conducive business environment, and a reputation for minimal corruption, it remains a formidable player among global economies. However, its growth pace hasn't been on par with other advanced nations, and according to OECD projections, this pattern may continue. When benchmarked against other developed economies, Canada's competitive edge seems slightly dulled. The IMD World Competitiveness Ranking positions Canada 14th out of 63 nations, its most subdued rank since the survey began in 1997. This ranking sees Canada trailing behind dynamic economies like Singapore, 3rd, and US, 10th. And even progressive countries like Denmark, the Netherlands, Norway, and Sweden, all celebrated for their stringent labour protections and competitive wages. However, it's crucial to note that a competitive index isn't merely a measure of a country's standing against its peers. It's more about gauging its productivity levels. Historically, Canada has demonstrated significant innovation prowess, even when pitted against more resource-rich competitors. One of Canada's most significant assets is its talent reservoir, teeming with some of the world's most adept professionals. The IMD report underscores this, placing Canada 11th in global talent rankings. But a challenge looms large: the phenomenon of brain drain. A considerable number of these skilled individuals are venturing south, enticed by more lucrative opportunities. Over the years, Canada's initiatives to foster research and entrepreneurship haven't been as aggressive as some of its counterparts. The nation's economic focus on natural resources has sometimes eclipsed the need to invest in areas like manufacturing, research, and business. However, it's not all bleak. Sectors such as financial services, real estate, and communications are witnessing robust growth. Toronto is carving a niche for itself as a financial epicenter in North America, with a burgeoning number of financial service headquarters. Adding to its accolades, Canada's banking system has consistently outperformed in the G7 for over a decade, making it one of the world's sturdiest. This was particularly evident when Canada navigated the global financial crisis with more finesse than the US, a testament to its well-regulated and cautious banking sector.